This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
At the beginning of the chapter, we saw how it was that we would prepare an income tax computation, and that income tax computation would be prepared for every individual UK taxpayer. Now that meant that from the day that you're born to the day that you die, for each tax year, you have ostensibly the requirement to prepare an income tax computation. And that stands true whether you're male, female, whether you're adult, child, whether you're married or whether you're single. And what we've now got to look at is the situation where if you have either a married couple or a couple in a civil partnership, again the rules are exactly the same here, so from now on we'll just refer to spouses, to a married couple. But wherever a married couple may have a joint source of income, we have a problem. If each of the married couple have their own individual income tax computation, how will we divide that source of joint income between them? And what we'll see is we have a very simple rule, but a rule that we can change via an election. Now, of course, elections that are made and available to taxpayers will only be made and only be exercised if they are of advantage. So what we've got to see is how does the normal rule on joint income apply, what election is then available, and in what circumstances would it be available. Plus, when we look at the ownership of assets by spouses or partners in a civil partnership there, when we look at that, what can we learn about trying to improve the tax position for the couple? So rather than just having one taxpayer, one part of the couple improving their position, how do you get a mutual benefit so that overall they pay lower tax? Okay, looking at the notes that we've got here, therefore, going back to chapter 2. Now, as you can see on the screen in front of you, section 6. Jointly owned assets, of course, is what we're talking in terms of here. And spouses and civil partners, as we've said, are taxed as two separate people. Each individual taxpayer will have their own individual income tax computation, attracting the income of that taxpayer. Joint property, where spouses, civil partners own income-generating assets jointly, it is assumed, now here is the very simple rule that applies, that they're entitled to equal shares of the income, and it is simply split on a 50-50 basis. It's known as the 50-50 rule here. So where jointly owned, irrespective of what actual ownership may exist, for a moment anyway, the normal rule is the 50-50 rule. Now, in terms of allocating the income sources, what type of income might we be talking in terms of? Well, probably the easiest example to contemplate is the fact that, say, the couple, the spouses, jointly own a property. Not, in fact, the property in which they live, but a property that is rented out. And on that property, for the tax year, we work out the net rental income accrued, less allowable expenses incurred. And once we've got that rental income to be assessed on the couple, we then simply split it 50-50. So it would be split equally between the two spouses. But then there is this election. They may make a joint election here to, obviously, HMRC to split the income according to their actual ownership shares, according to their actual ownership. So be careful. This is not an election that allows the spouses to divide up this joint source of income any way they like. What it is the ability to go from 50-50 to split it according to actual ownership. So if, for example, the property was owned 60% by the wife and 40% by the husband, then the election would split it 60-40 in that ratio there. Now, I'll have an example on this in a moment, and we'll see the circumstances and the reasons why it may be advisable. Just one point there before we go. We say that we've got this ability to make this election true, except in the case of a jointly held bank or building society account. If you've got this interest-producing account, then there is no ability to try to split that according to actual ownership. because it'd be ridiculous trying to trace where the actual monies had come in from him, from her, whatever it might be. Ridiculous. So again, not in the case of your bank and building society accounts. What these rules will allow is for couples here to rearrange joint income between them to better use their personal allowances, and also to get lower tax rates, thereby reducing their overall tax liabilities. So the idea, therefore, is if we've split it as we would according to the normal rule 50-50, but one of the spouses is not using all of their personal allowance while the other spouse is, and/or one of the spouses is a higher rate taxpayer and the other taxpayer is either not a taxpayer or merely a basic rate taxpayer, there would be the ability, depending on the actual ownership proportions held by the two spouses, to try to move income from the higher rate taxpayer to the basic rate taxpayer, or from the higher or basic rate taxpayer to the spouse that has some unused personal allowance, allowing therefore income to be entirely free of tax. Now, let's have a little example at this point, and if we just go to here, this page, we can set up, and you can copy down now the information provided here. Okay, we've got the situation where a husband has got £15,000 of income and the wife £60,000 of income. Didn't he do well? Well done, the lad, indeed. So he's got 15,000, she's got 60,000. They both have a personal allowance of 11,000, leaving the husband with a taxable income of a mere 4,000. He clearly is a basic rate taxpayer. Wife has taxable income of 49,000 and is clearly therefore up into the higher rate band. Within the income figures, we're told that husband and wife jointly own a property, the actual ownership of which, and we'll come back to the use of this in a moment, is husband owns 75%, wife owns 25%. And that jointly owned property has produced, for the tax year, £10,000 of net rental income. Now, the 50-50 rule, of course, means that 5,000 will have gone to him and 5,000 will have gone to her, and they will be a part of his 15,000 and her £60,000. Here, no election has been made in relation to this income, which means, when no election has been made, that it is quite simply the 50-50 rule that has therefore applied. Okay, so at the moment, therefore, the situation that we have when we look at the way in which the income has been split is we've got 5,000 to him, so the husband has got 5,000, and that 5,000 added to his other income of 10,000 has generated £4,000 of taxable income within the basic rate band. So the 5,000 allocated, 1,000 is at 0% because it's covered by the personal allowance. He had other income of 10,000, personal allowance of 11,000. So the first 1,000 of this 5,000 rental income is at 0%, therefore. The remaining 4,000 is at 20% basic rate. Whereas for the wife's 5,000, she is a higher rate taxpayer on all of this £5,000, so all of the 5,000 is being taxed at 40%. So clearly on his 5,000, a much lower tax charge is being achieved. £1,000 of his income is not being taxed at all because it's covered by the personal allowance, and then 4,000 is at basic rate of 20%, as compared to her 5,000, where we're talking then in terms of it all being in higher rate band. Now, the election that is available, otherwise known as a declaration of beneficial interest, should you ever see that language used here, depending on what text you are possibly using or referring to, declaration of beneficial interest, that would be split the property according to actual ownership. So let's remind ourselves, he's got 75% and she's got 25%. That would mean, instead of 50-50, 5,000, 5,000, husband would be allocated with his actual ownership share, £7,500, and the wife would get a mere £2,500. Now, I'll ask you, do you think that that will improve the tax position of the married couple, such that a lower amount of tax overall will be paid? Now, I hope, therefore, you are saying that if it's now 7.5, 2.5, instead of 5, 5, we're moving £2,500 of income at the moment allocated to her, and that £2,500 out of at the moment her 5,000, that 2,500 is being taxed at 40%. And we're moving the 2,500 from her over to him, adding it to his £4,000 of taxable income, which means that the next £2,500 would all be taxed at 20%. So that income that is now being moved from her, where it was taxed at 40, to him, where it's being taxed at 20%. That's a differential in tax rates of 20%. And £2,500 at 20% is a £500 tax saving. Yes, this would indeed be a good idea to make that declaration of beneficial interest. Point to note here that it doesn't work retrospectively, it only works here for the future. So if you make this prior to the start of the tax year, it will then be relevant for that forthcoming tax year. So here, as we said, what election is available and what tax saving would be achieved if it had been made. Too late to do it now, but if this is the same situation for the next tax year that we would face, we could achieve overall for the married couple a tax saving of £500. Again, understand why. Instead of 5,000, 5,000, it's now 7.5, 2.5. That's an extra 2,500 going to him rather than her, where in his hands it's taxed at 20% rather than in her hands where it is taxed at 40%. The saving, £500. 20% differential in tax rates on £2,500 of taxable income. Now, of course, if you had been told here that the actual ownership was that he owned 25% and she owned 75%, then the last thing you would want to do is to make this election. You are happy, they are happy with the normal rule that says split it 50-50 there, because in that way it's 5-5, whereas she would otherwise be taxed on an extra 2,500 at 40% instead of in his hands at 20%. So just because the election is available does not mean to say it would always be worthwhile. Here, where it would mean moving income from the higher rate taxpayer to the basic rate taxpayer, or in other circumstances where if the income of the husband had been even lower, you were moving income either out of higher rate or out of basic rate, but back into his computation where it would be covered by his personal allowance that was otherwise unused and wasted, then being able to have income not taxed at all is better, of course, than paying any tax, be it 20 or certainly 40% there. So that's the circumstance in which it would be a worthwhile election, where you're moving income from a higher to a basic rate taxpayer, or either a higher or basic rate taxpayer, moving it to a non-taxpayer. And we should be able to evaluate the tax savings. Now there we had a jointly owned asset, and we saw where that declaration of beneficial interest, that election, would be worthwhile and the reasons why it would. What we'll now do is to look at another circumstance where if we now imagined that the wife owned the entire asset, then if she at the moment owned the entire asset, the income figures would now be, well, if she had the whole 10,000 rather than splitting 5-5, the husband's income would only be £10,000 without the 5,000 rental, and her income would be up by 5,000 because you now have the whole £10,000, so it would go up to 65,000. It would mean, of course, that he now had no taxable income, indeed has got £1,000 worth of unused personal allowance, and she is, of course, still and remains a higher rate taxpayer. Now, if that was the situation, what recommendation might we have in relation to the ownership of that rental property? As I say, at the moment, it is owned entirely by the wife. Can we think of any action here that might be taken as regards the ownership of that property to improve their overall tax charges? Now, I hope that you would be able to consider here, and maybe the guys out there rather than the girls are probably keener on this outcome than the others, would be that if she were to sign over the ownership of that property to the husband, then think what would happen. We would be moving £10,000 worth of income from her across to him. Now, at the moment, the £10,000 in her hands is being taxed at 40%. Clearly, she is a higher rate taxpayer. So the 40%, there's going to be £4,000 worth of tax in relation to that rental income. If we move all of that income across to him, now you can't do this artificially. We can't pretend that it's his income, that it's his property. The wife here must legally transfer the ownership of the property across to the husband. Now, if she was willing to do that, and maybe that's a question, if she was willing to do it, then the £10,000 in his hands, adding to the existing 10,000, got a personal allowance of 11, so the first £1,000 would be covered by the personal allowance, so there would be no tax charge there, and all of the remaining 9,000 would fall in his basic rate band. Hence, therefore, if my mental arithmetic is correct, £1,800 would now be the tax liability that the married couple would be suffering in relation to the £10,000, I beg your pardon, of rental income. In her hands, that 10,000, all taxed at 40%, £4,000. If we moved it across to him with his level of income such as it is, the first £1,000 mops up the remaining, utilises the remaining nil rate band, personal allowance, therefore no tax, and the £9,000 is then taxed at 20% basic rate tax. £1,800 compared to 4,000, we're talking there about a saving possible of £2,200. That's a lot of money. That's a lot of tax that here could be saved if, for the future anyway, she transferred the ownership of the property over to him. Now, say that's where, practically speaking, with your married couple or your civil partners, you may have a problem, because that would require here for her to agree to transfer the ownership of that property, a property that might be worth £200,000, £300,000, £400,000. Is she going to be able to do that? Well, she's able to do it. Whether she wants to do it is another matter. And now, the worry that she might have if she transfers the property across to him, it then becomes his, and he keeps on going and takes it with him, therefore. Now, she might equally consider, of course, that that's a price worth paying to get rid of him, but not for us there to have that conjecture. But certainly, in tax-saving terms, £2,200 could be saved, given the levels of income that they currently have, if only the asset were to be transferred. Now, bearing in mind a possible reluctance on the part of the transferor, there is potentially a sort of compromise that here could be made. And that compromise would be if now the wife transferred some sort of nominal interest, let's say, and again it doesn't matter which percentage you choose, but let's say 5%. If W transferred 5% of the property, or whatever the asset might be, to the husband, then what does that make the asset? the asset is now therefore is jointly owned. And if the asset is jointly owned, irrespective of the actual ownership percentages, proportions that may apply, if it's jointly owned, then what rule applies? And of course, the rule is the 50-50 rule. So what that would mean going forward is that we'd split the income as we started off this discussion with when it was jointly owned. We're going to split it 5,000, 5,000, in which case £5,000 worth of income that was hers, that was being taxed at 40%, that was therefore £2,000, becomes his, that's the wife, now the husband. He gets the 5,000, half 50-50 on the £10,000 net rental income, and that 5,000 would mean 1,000 at 0%, 4,000 at 20% equals 800, and you'd therefore be talking about a £1,200 tax saving. Not as good, clearly, as 2,200, but it's certainly better than nothing. So again, we would be able to give advice to the taxpayers about what improvements could be made in terms of their current tax position. At the moment, she is the higher rate taxpayer. She owns the asset outright and gets all of the income as a result. If you transferred some nominal amount across over to the husband, that would make it jointly owned, and therefore the 50-50 rule would apply. So half of her income currently being taxed at 40% would, as we've just seen here, be allocated to him, where the first 1,000 wouldn't be taxed at all, covered by the personal allowance, and the remaining 4,000 of taxable income would be taxed at 20%, the basic rate, a saving of £1,200. So here we can see if we're faced with a situation where an asset is currently jointly owned, we may be asked to deal with it in terms of the income tax computations, i.e. without an election you apply the 50-50 rule, and possibly advise what might be done to improve their overall tax position for the future. That would be to consider a declaration of beneficial interest. That would only be worthwhile if we were moving more of the income to the lower taxed taxpayer and away from the higher taxed taxpayer. That is the only circumstance it would be worthwhile. If we face a situation where, like in the second scenario, we don't have a jointly owned asset, we have an asset here that was owned by the wife, she was a higher rate taxpayer, and therefore all of the net rental income was being taxed at 40%. What might we recommend here? If she was willing, best outcome, transfer all of the ownership of the property across, therefore using up any available personal allowance, and then what is to be taxed is taxed at the basic rate instead of at 40%. As a compromise, where she only has to forego ownership of a relatively small proportion of that asset, that would allow half of the income, applying the normal joint income rules, to then move across and be taxed at the lower rate or rates. Okay, now if we just return back to your note for one moment, there we go. There's a little point there about shares, jointly held shares, and the dividends that come from them, and where that we divided according to the exact proportion to which each is actually entitled. Never assumed it would be in equal proportions. Don't see that arising. If it did, they'd have to tell you what those proportions are and you apply them. But as we've just seen, the 50-50 rule may also be used to reduce income tax liabilities where a higher tax rate taxpayer currently owns outright an income producing asset, the wife in the previous example, while the spouse is not fully utilising either the personal allowance and or the basic rate band. Then, as we've seen, a transfer of a nominal amount of the capital, we used 5%, would allow the joint income rule, so 50% of the income, to be assessed on the lower taxed transferee spouse. Obviously, as we've seen, if the transferor spouse was willing to do it, then it would make sense to transfer the entire ownership, and that would achieve an even greater amount of tax. And we've evaluated with that previous example the large tax savings that would have been available in our particular example. Okay, little example for you to have a go at there to discuss and evaluate how Elton and David could reduce their income tax liabilities and to identify, if you would, the amount of tax saving that would be achieved. So what I'd like you to do, therefore, is to have a little go at that exercise and then have a thorough review through the answer and make sure you're happy with these basic tax planning principles. We will return to this idea of tax planning, specifically with married couples, in our very final chapter in the text, the tax planning, chapter 26. Now here, and hopefully you've understood from what we've said and what we've seen, that it would make sense to be able to move income that would have been taxed at 40% to a transferee spouse where it would be taxed at either 20% or 0%. And we've seen the tax savings that would be available. Well, with the changes that have been brought about in our most recent Finance Act of 2016, we've seen introduced those savings income and dividend income nil rate bands. So what you may now get, of course, is a planning situation where what the taxpayers are trying to do is to better utilise those nil rate bands. And as we'll see in chapter 26, you might get the odd circumstance where now it's actually worthwhile transferring some part of an asset or ownership of asset or assets in the form of accounts that earn interest, shares that receive dividends, to transfer the ownership of those actually from the lower taxed taxpayer to the higher taxed taxpayer. If you've got a basic rate taxpayer who's got savings income or dividend income in excess of their nil rate band, then that income is being taxed, be it savings income above again the nil rate band at 20%, be it dividend income above the nil rate band but still in the basic rate band at 20%. It would seem odd to choose to move some of that income across to the higher rate taxpayer. But if that higher rate taxpayer was not using either or both of the savings income nil rate band, that'd be £500 for a higher rate taxpayer, or the standard £5,000 of dividend income nil rate band, then by moving it to the higher rate taxpayer spouse, you wouldn't be moving it into a higher rate, you'd be moving it into a freshly available nil rate band, and therefore tax savings could be achieved. So it makes this question, therefore, of arranging the ownership of income producing assets carefully between the spouses. It makes it an even more interesting decision than ever it was before the 2016-17 tax year. But the pleasure of reviewing that and those planning issues, that awaits you at the end of your studies in chapter 26. For the moment, please, would you have a little go at example 16, review, and then return to us. Well, having spoken in recent times about how tax liabilities might be reduced, either through payments that might be made, gift aid payments, personal pension contributions, or action that could be taken, declaration of beneficial interest, as we've just seen, or moving ownership of assets, income-producing assets that is, from one spouse to the other, we now go to an outcome that is unfortunately going to increase the tax liability of the taxpayer. And what we've got is an income tax charge, thus an increase in income tax liability. This will be an addition in deriving the income tax liability in relation to something called a child benefit. Now, a child benefit is a tax-free benefit that's payable by the government to parents, irrespective of the level of the taxpayer they may be. So it's always been a universal benefit, and a very generous one, paid by government to parents to give them cash in their pockets to better look after their children. And this amount of child benefit varies then on the number of children that the parent may have. And for many, many years, it was a universal tax-free benefit. It was then decided, however, that if a taxpayer had sufficient income, then they didn't really need and shouldn't be provided with the benefit, this child benefit. They've got enough money to look after themselves, basically, there. Now, what happens here is if, however, a person's adjusted net income, now there's a term I hope you will recall, and I'll remind you of that and we'll define it again in a moment. But if a person's adjusted net income, or indeed whose partner's adjusted net income, exceeds £50,000 and they receive child benefit, then a child benefit income tax charge will arise to, not immediately, we don't just say, oh, right, you've gone over 50,000, you lose the child benefit, we're going to take back all of that child benefit in the form of this income tax charge. No. What we will do is to gradually remove the benefit from such higher income earners, such that, so it's on a sliding scale, such that when you reach 60,000 of adjusted net income, by that point, the benefit will be entirely removed. So over this £10,000 worth, from 50 to £60,000 worth of adjusted net income, as you move through from 50 to 60, we proportionately have this income tax charge to take away the benefit of the cash, the child benefit that they have already received. They've had the cash in the pocket, shouldn't have had all that cash, or if they've got adjusted net income over 60,000, they shouldn't have had any of the cash, and therefore we increase the income tax liability accordingly. Now, how that works we'll look at in a moment, but the critical figure there was the individual's adjusted net income. Now again, I do hope that you remember what that adjusted net income figure is and where we saw it. Now, the relevance of the adjusted net income was looking at the situation where a taxpayer's personal allowance may be reduced from the normal £11,000, well, down to zero. That was dependent on whether the adjusted net income of the taxpayer exceeded the income limit of £100,000. If it did, then for £1, by £1 for every £2 worth of income, we would reduce the personal allowance, such that the entire £11,000 of personal allowance will have gone by the time the taxpayer's adjusted net income reaches £122,000. Now, that adjusted net income, what was it? We know where it was used and how it was used there, but what was it? Now that, of course, off the face of the income tax computation itself, was the net income figure, and then adjusted by deducting from it certain payments that may have been made by the taxpayer. And if paid during the tax year, they would be deducted. And what we deducted there was, as we referred to it, again, I hope you remember, the gross equivalent of any gift aid payments or any personal pension contributions paid. Now, when we say the gross equivalent, we said that those payments were made net of basic rate relief being achieved at source. Therefore, an £80 gift aid payment became a £100 gross gift aid payment. An £8,000 personal pension contribution actually paid became a £10,000 gross personal pension contribution. And by those gross amounts of those payments made, we would reduce the net income down to adjusted net income. Well, it's that self-same adjusted net income figure that is to be used here. And if that figure exceeds 50,000, we will start to reduce proportionately between 50 and 60,000 adjusted net income, the level of the child benefit received by the form of an income tax liability, a tax charge, an income tax charge. Once the adjusted net income goes above 60,000, then all of the benefit of the child benefit, the cash received, all of it will be taken back in the form of an increase in the income tax liability. So people can't end up worse off than they were. They simply will not have benefited at all from any of the child benefit received, if indeed their adjusted net income exceeds £60,000. Someone in this situation, if they know their adjusted net income is going to be in excess of 60,000, can simply opt to not take the child benefit, and therefore there is no child benefit income tax charge because they've never received the child benefit in the first place. A few other bits of admin before we do some examples. If both partners have income over £50,000, guess what? It is the partner there with the higher income that is liable for the charge, obviously increasing the amount of income tax charge here. As we've said, where the adjusted net income falls between £50,000 and £60,000, the income tax charge would amount to 1% of the child benefit received for every £100 of income in excess of £50,000. So on £1 tax liability for every £100 of income, it means that over the £10,000 worth of adjusted net income, a pound for every 1% there for every £100, 1%, you'll get 100% taken away by the time you get to the £60,000 figure. Now that information is actually, and thankfully, provided to you in the exam on your normal tax rates and allowances page there. The wording of it, as stated there, where income is between 50,000, you have to remember that it is adjusted net income to which we refer. Between 50 and 60, the charge is 1% of the amount of the child benefit received for every £100 of income over 50,000. As we said, go over 60,000 and all of the child benefit will be clawed back. It will all be an increase in your income tax liability. The income tax charge is added in deriving the income tax liability of the taxpayer. Right, couple of illustrations here. First of all, Catherine received child benefit of £1,056 in 2016-17. So she was paid by the government, got cash received of £1,056 during the tax year, the child benefit for a child. But we then discover that for the tax year 16-17, she's got adjusted net income for the year of £54,000. That means that HMRC will now claw back some of the child benefit that they have given to Catherine in the form of a child benefit income tax charge. What is that charge? It's 1% for every £100 of income in excess of the income limit of £50,000. So as we say, income between 50 and 60, child benefit income tax charge is. Now, there's your child benefit received, and it's going to be reduced by 1% for every £100 that adjusted net income exceeds the income limit. So adjusted net income 54, income limit 50, 4,000, divide by 100, and that is 40%. Take 40% of the £1,056, and that, hopefully if my maths is correct, is £422. So that will be the child benefit income tax charge, and it will be added in deriving the income tax liability. So Catherine will have received £1,056 of cash payments, cash benefits, child benefits during the year, and then their income tax liability will be increased by 422 to take back that part, effectively, of those child benefits that she shouldn't have had in the first place because her income, her ANI, is above £50,000. Second example, Victoria this time receives child benefit of 3,147 in respect of her 4 children, but she's got adjusted net income of £77,000. That clearly exceeds 60,000. So it means, of course, that she shouldn't benefit at all from the child benefit received of 3147. So she will face a child benefit income tax charge of the full £3,147, the full amount of the child benefit received. She was given the money and then it's taken back again by the government based on the fact that her adjusted net income exceeds 60,000, and that will be taken back in the form of this child benefit income tax charge, which is added in. So once you've done your basic rate, your higher rate, if necessary, any additional rate if necessary, then you would add in the child benefit income tax charge in deriving the income tax liability. Okay. Again, now have a review through the two sections that we've looked at in this particular lecture. It leaves us, I'm happy to say, with just one more lecture, one hopefully relatively short lecture for us to deal with, which looks at the final section in this very large chapter 2 that deals with what we call the residence of the taxpayer. Now, I'd like you to read through, not trying to learn parrot fashion, as it were, every point here, but just have a little read through. Familiarise yourself with the information and what the issues are, so that you'll be better able to understand the rules as I take you through them next time. What it is all about is that a taxpayer's liability to personal taxes, notably here, of course, we're interested in income tax, but there's other personal taxes, capital gains tax and inheritance tax here, is based upon primarily the residence, but also something known as the domicile of the taxpayer. Now again, you're not going to have to worry about these terms, other than you may be asked now, for purposes of income tax, to define whether or not a taxpayer, based on the number of days they've spent within the UK, is classified as UK resident or not UK resident. Now, the reason why for the taxpayer it's very important is that what we need to know is that a UK resident will be liable to income tax on worldwide income. So the fact that you've got income overseas as a UK resident does not shelter it from UK taxation. You are liable on worldwide income, whereas a non-UK resident will only be liable to UK tax on UK income. It's therefore essential to know whether or not a taxpayer is or is not UK resident to be able to determine what UK tax liability, if any, they may have. Clearly, you would prefer to be classified as non-UK resident so as to shelter all of your non-UK, your overseas income from UK taxation. Right. You'll find, as you can see there, a little sort of grid working that looks at the number of days in the UK and then gives some very strange terms based on whether you were previously or not previously resident. Again, that is information that is provided to you, but you'll need to read through, in your tax rates and allowances, which will allow you in the more difficult circumstances, which probably would be a Section A objective testing question, to determine whether or not the taxpayer is going to be classified as UK resident. What we'll be looking at and we'll define and talk through next time after your review will be in what circumstances, without applying the little chart that you see there, would a taxpayer be automatically non-UK resident or automatically UK resident, and if neither, then we'll have to look at that little listing that you see here, thankfully provided in the exam to you. That's not a learning exercise, to determine whether or not they'll be UK resident. So just spend a little time before I talk to you next time in this final, what will be the final presentation on the Chapter 2 about determining whether a taxpayer is or is not UK resident. Again, I look forward to talking to you then.